Why is it that some people can raise millions of dollars with just one phone call, while others spend years proving themselves, yet still can't get anyone to believe in them? Same idea, same plan, but one gets funded and the other gets rejected. The difference isn't in the number of zeros in their bank account, it's in the amount of trust they've built over time. In the world of finance, money can buy almost anything, but it can't buy trust. And once you lose it, everything else collapses faster than a stock price during a market crash. Stephen M.R. Covey, son of the legendary Stephen Covey, once said, "Nothing is as fast as the speed of trust." When trust is high, everything moves faster, costs less, and opportunities multiply. When trust is low, everything slows down, stress builds up, and risks double. That's why truly wealthy people don't just invest in stocks, real estate, or companies. They invest in trust, both in others and in themselves. In this video, we'll explore why trust is the fastest growing invisible asset in the world, and how you can use it to build lasting wealth even if you don't have much money yet. Part 1. Wealth starts with trust. There's something fascinating about truly wealthy people. They rarely talk about money. They talk about reputation, commitment, and trust. Think about this. Why can Warren Buffett close billion-dollar deals with just a handshake? Why can Elon Musk raise hundreds of millions from investors based only on a promise of a better future? And why can some ordinary people who weren't born rich build massive wealth while others keep struggling? The answer isn't in IQ or degrees. It's in the level of trust they've built around themselves. Trust is the first currency you must earn before a single dollar ever hits your bank account. Trust is when you say, "I'll do it," and people believe you actually will. Trust is when you commit to a value and live by it, even when no one's watching. Trust is when the market, your customers, and your colleagues see your name as a guarantee of quality. That's when trust becomes an invisible asset, yet one with infinite financial value. Imagine you're signing an investment deal. Two people offer you the exact same terms. One you trust, the other you don't. Who do you choose? The answer comes almost instinctively. You choose the one you trust. Stephen M.R. Covey calls this the economics of trust. In this economy, trust acts as a catalyst. It shortens time, lowers costs, and accelerates success. When trust is high, everything moves faster, smoother, and cheaper. When trust is low, everything slows down, gets more complicated, more expensive, and far more exhausting. Just look at American society today. A company that loses customer trust, its stock can crash overnight. A leader who loses team trust, their organization collapses even if the finances stay strong. A relationship that loses trust, love, wealth, and reputation all fall apart together. That's why Covey said, "Trust is the one thing that changes everything." If you want to build lasting wealth, you can't rely on money alone. You need to build trust capital, the kind that makes people want to work with you, invest in you, and stay with you for the long run. Because in the end, people don't invest in ideas. They don't invest in products. They invest in people they trust. And when you become that person, money, opportunities, and success will naturally find you. Trust is not just a virtue, it's a financial asset. Stephen M.R. Covey. So if you truly want to become wealthier, start today by asking yourself, how many people truly trust me? And if that question makes you hesitate, then that's exactly where your wealth-building journey begins.
Part 2. Trust, the invisible financial leverage. In the world of finance, everyone talks about leverage. debt leverage, investment leverage, technological leverage, but there's one kind of leverage that's far more powerful, and it doesn't appear on any balance sheet. The leverage of trust. Take this simple story. A startup in San Francisco, only 6 months old, no profit yet, not even a finished product, and yet they just raised $50 million. Why were investors willing to fund them? Because they believed in the founders, believed in their vision, their integrity, and their ability to make promises and keep them. Meanwhile, hundreds of other companies with better models and more detailed plans couldn't raise a single dollar. Not because they were less intelligent, but because they lacked one crucial asset: trust. Stephen M.R. Covey calls this the trust dividend. When trust is high, everything accelerates. You close deals faster, attract top talent more easily, and your customers become more loyal. But when trust is low, costs rise at every level. Audits, supervision, paperwork, verification, and even suspicion. You don't just lose money, you lose time, energy, and opportunity. In economics, that's known as transaction cost. Covey takes it further. He says the greatest cost isn't written in contracts, it's hidden in the absence of trust. And if you look closely, it's true everywhere, from Wall Street to Main Street. Take the stock market, for example. When investors trust a company, its share price can soar just from a positive statement by the CEO. But when trust disappears, a single rumor can wipe out billions in market value overnight. Trust is the catalyst of cash flow. Without it, the economy stops moving. And in your personal world, the same rule applies. If people don't trust you, no one will collaborate, no one will invest, and no one will open doors for you. Covey wrote, "Trust is the one thing that, if removed, can destroy even the most powerful organization, and if developed, can create unprecedented success." Trust may be invisible, but it changes how the world responds to you. It makes people listen when you walk into a room. It gets your emails answered faster, and it gives your word more weight than a written contract. In other words, trust is money, just in an invisible form. It's an asset you can't measure in dollars, but it shapes every step of your financial and professional journey. Truly wealthy people understand this. They build financial assets, yes, but at the same time, they invest in trust capital. They answer calls on time. They keep their promises, even when no one's watching. They act fairly, even when they don't have to, because they know this truth. When people trust you, you don't just have influence, you have speed. Speed in business, speed in investing, speed in your career. And that speed is what separates you from the crowd. Covey calls it the speed of trust. So if you want to multiply your wealth, don't think only in terms of financial leverage. Think in terms of reputation leverage, because that's the kind of capital that compounds forever.
Part 3. The 4 cores of financial credibility. The foundations of trust among the wealthy. Trust isn't something you can buy, borrow, or fake. It's built through small, consistent actions and lost in a single moment of dishonesty. Stephen M.R. Covey once said, "Trust isn't built overnight, but it compounds just like money." Trust grows like compound interest. Every time you keep your word, it increases a little more. Every time you break a promise, it crashes faster than the market on Black Monday. According to Covey, every lasting form of trust is built on 4 essential cores, the 4 pillars of financial credibility, that all truly wealthy people quietly nurture every single day. 1. Integrity, living in alignment with your values. People can forgive mistakes, but they rarely forget deceit. Integrity isn't just about telling the truth. It's about consistency, when your words, actions, and values all align. Warren Buffett once said, "If you lose money for the firm, I will understand. But if you lose reputation, I will be ruthless." In the world of finance, where every decision revolves around trust, integrity is the strongest currency. When you're transparent, when you admit mistakes instead of hiding them, you send a powerful signal: I'm trustworthy. A financial advisor doesn't have to be the smartest in the room, but if clients believe he always puts their interests first, they'll stay with him, even when the market collapses. 2. Intent. What's your real motive? People have a natural radar for intent. They can feel when you genuinely want to help them, and when you're just trying to sell something. Covey said, "When people sense duplicity, trust evaporates instantly." Sustainable wealth isn't built on manipulation. It's built on long-term goodwill. The understanding that trust takes time to grow, but once you have it, it becomes a form of social capital that opens every door. For example, an entrepreneur might walk away from a lucrative deal if it would harm his customers in the long run. At first glance, it seems like a financial loss. But in reality, it's an investment in integrity. And that kind of investment pays off longer than any stock ever could. 4. Capabilities. Your real competence. Trust doesn't come only from good intentions. It comes from your ability to deliver. If integrity is the heart of trust, then capability is its brain. No one will trust you forever if you can't produce results. Covey wrote, "You can't talk yourself into trust. You have to earn it through competence." In finance, capability might mean investment knowledge, analytical skills, or leadership ability. For the average American, it might mean managing a budget wisely, understanding taxes, and staying calm when the market shakes. Truly wealthy people never stop learning because they understand that every new skill is another brick in the foundation of their credibility. 4. Results. The ultimate proof. Even if you have integrity, intent, and capability, without results, trust will eventually fade. People believe in track records, not talk. In investing, you can discuss strategy all day, but in the end, the numbers tell the story. Covey calls this the credibility dividend. When your results consistently deliver, people trust you more, and that trust automatically attracts new partners, new deals, and new capital. The wealthy understand that results aren't just about money. They're about reputation that earns interest. Every time you meet a deadline, repay a debt, or help someone achieve their goals, you're depositing trust credits into the invisible bank account of your life. When these 4 cores, integrity, intent, capability, and results, come together, you become more than trustworthy. You become investable, the kind of person others want to work with, follow, and support. That's why trust isn't just a moral virtue. It's a financial asset. A trustworthy person might lose everything, but they'll always have a way to rebuild, because people will want to help them rise again.
Part 4. Trust in investing. When the market loses faith, opportunity appears. There's a paradox that only true investors understand. When trust disappears, profits begin to form. Think back to 2008. Wall Street collapsed and confidence vanished overnight. Lehman Brothers went bankrupt. Millions of Americans lost their jobs, their homes, and their faith in the financial system. But in the midst of chaos, a few people quietly started buying stocks, not out of blindness, but because they understood a simple truth. Markets run on trust. When trust collapses, prices lie. Stephen M.R. Covey once said, "When trust is low, speed goes down and cost goes up." That principle applies not only to organizations, but to every financial crisis in history. When trust evaporates, investors become fearful, businesses grow cautious, and every decision slows down, dragging asset prices with it.
But for those who understand the language of trust, this isn't the end, it's an invitation. Trust is the invisible currency of markets. At its core, the financial market is a massive trust system. The US dollar has value not because of the paper it's printed on, but because people believe in it. Apple's trillion-dollar valuation doesn't come from a piece of stock paper. It comes from investors believing Apple will continue creating value. And when that belief starts to shake, when questions like, can the Fed really control inflation? Or is the banking system still stable, flood the headlines? That's when the most disciplined investors quietly start building wealth. Because they know, just like in life, trust disappears faster than it's built, and every recovery of trust brings a recovery of value. They don't invest in the crowd, they invest in the comeback of confidence. Trust isn't just a feeling, it's data. Covey said, "Trust is not a soft skill, it's a hard economic driver." In investing, trust reveals itself through real behaviors. When consumers start spending again, when companies dare to expand after quarters of cuts, when capital flows back into stocks instead of hiding in gold or bonds, the truly wealthy don't wait for good news on CNN. They watch trust returning at the micro level through subtle signals most people overlook. For example, during the 2020 pandemic, while the world panicked, investors who understood the power of trust recovery were quietly buying companies with strong brand credibility, like Amazon, Microsoft, and Johnson & Johnson. They knew that when consumer trust returned, these trusted brands would be the first to recover. When trust is gone, invest in what's still trustworthy. During crises, everyone searches for a safe haven, a place to park their faith. That might be gold, government bonds, or simply companies built on ethics and clear values. Look closely. America's most enduring giants, Costco, Apple, Berkshire Hathaway, all share one thing in common. They keep their promises, stay transparent, and never chase fads. That's why in every downturn, they attract trust, and that trust turns directly into real money. Meanwhile, dishonest or overhyped companies, no matter how profitable in the short term, eventually collapse like sandcastles. Trust is the ultimate test, and the market always punishes the fake. The investor's lesson: don't just buy stocks, buy trust. When you invest in a company, you're not just buying products, balance sheets, or logos. You're buying leadership, culture, ethics, and vision. Those things don't show up on financial statements, but they're the compound interest of trust, the invisible force that keeps a business alive through decades of change. Trust helps you stay disciplined when the market panics, stay patient when others give up, and stay calm while opportunities quietly take shape in the dark. Trust is the most undervalued asset in every market. Yet history proves this truth. Every time the crowd loses faith, those who understand trust become wealthy. Because in the end, money itself is just a story, and the truly rich are the ones who understand how that story works.
Part 5. Building a wealth network. Accumulating trust as an asset. There's an old saying in American business: your network is your net worth. But as Stephen M.R. Covey would add, only if your network is built on trust. Trust, not just in money, but in people, is the most sustainable asset you can build over a lifetime. From handshakes to million-dollar opportunities. Look at Warren Buffett and Charlie Munger. Two friends, two minds, and one unwavering belief that you should invest in value, people, and principles. For more than half a century, they didn't need contracts hundreds of pages long. They only needed a handshake. That wasn't luck. That was trust, compounded like equity. That trust allowed them to never doubt each other during market turmoil, make decisions fast without fear of betrayal, focus all their energy on creating real value instead of playing defense. You can make millions, but if you live in suspicion, always afraid someone will take advantage of you, you're burning emotional interest every single day. On the other hand, when you invest in trust, in the right people, in the right relationships, your social cash flow never stops growing. Trust is the currency that flows through every relationship. Stephen Covey once said, "Nothing is faster than the speed of trust. When you trust someone, you shorten the time of every transaction, reduce costs, and boost collaboration. That's the financial mechanism of trust. Imagine two entrepreneurs starting at the same time. The first spends 6 months checking, doubting, and verifying everything. The second starts with a trustworthy partner and uses those 6 months to build products, meet customers, and create value. Who do you think will go further? Trust helps you move faster, learn faster, and multiply opportunities faster. In a world where everyone is afraid of being scammed, the person brave enough to trust the right person goes the furthest. Accumulating trust like an asset, the real wealth formula. The rich don't just invest in stocks or real estate. They invest in reputation, the kind of asset that creates opportunities money can't buy. Covey said, "Reputation is a dividend of trust. The more you invest in trust, the higher your credibility yield." Look at people like Oprah Winfrey, Elon Musk, or Jeff Bezos. Their true wealth isn't just in dollars, it's in trust capital. Millions of people believe them, listen to them, and bet on their vision. That's why they can raise billions with a promise, or create entire markets with a single statement. Trust compounds like interest, and one careless word can erase the trust capital built over decades. That's why truly wealthy people are careful with their words, honest about their mistakes, and consistent with their values. They know that every action is a trust transaction. From network to trust network. You can have thousands of contacts in your phone, but if none of them truly trust you, that's not a network, that's a contact list. A wealth network is built on 3 pillars: consistency, do what you say; transparency, no hiding, no half-truths; respect, put shared goals above ego. When you build relationships on those values, opportunities naturally find their way to you. No chasing, no forcing. People will want to work with you, invest with you, and support you because they know your trust is worth more than your money. The final lesson: treat trust like a real asset. If you lose money, you can earn it back. But if you lose trust, it might take a lifetime to recover, if ever. The wealthy understand this. They manage trust like they manage a portfolio. Diversify your relationships. Reinvest through kindness and integrity. Avoid high-risk assets, the two-faced and the unreliable. Because in the end, wealth isn't about how many people you know. It's about how many truly believe in you. Trust can't be measured in numbers, but it is the currency behind every success, career, finance, and even happiness. And when you've built enough trust capital, you don't just become richer, you become freer.
Part 6. Trust creates speed, the compound interest of trust. Think back to the last time you worked with someone you completely trusted. You didn't have to double-check every detail, no endless email chains, just a quick message, a simple nod, and everything flowed effortlessly. That feeling, fast, light, efficient, is what Stephen M.R. Covey calls the speed of trust. Covey said, "When trust goes up, speed goes up, and cost goes down. When trust goes down, speed goes down, and cost goes up." That's not just a philosophy about relationships. It's an economic law of trust. Trust, the lubricant of every economy. Imagine an economy where no one trusts anyone. Contracts grow 50 pages longer, audits double in frequency. Every decision needs 5 levels of approval. The result, everything slows down. Costs rise. Opportunities disappear. But in an environment built on trust, inside a company where employees believe in their leaders, or a business where customers have full confidence, everything moves at the speed of light. Amazon is the perfect example. They built customer trust on 3 words: Trust the experience. You click buy now, and you don't worry about a thing. That trust allows them to process millions of transactions a day, faster, cheaper, and more efficiently than anyone else. That's the compound interest of trust. Trust creates speed, speed creates value, and value compounds over time. In investing, trust sharpens decision-making. When you trust your investment philosophy, you don't panic every time the market shakes. When you trust the management of the company you invest in, you can hold through the red days without sleeping much. Warren Buffett once said, "It takes 20 years to build a reputation and 5 minutes to ruin it." He knows that trust is the rarest asset in the market. That's why he invests in companies with a culture of trust, where people do the right thing even when no one is watching. When trust is high, markets recover faster. When trust collapses, crises drag on longer. That's why true investors don't just read financial statements. They measure the speed of trust inside the organization. In life, trust saves time and energy. Think about your personal relationships. With people you trust, you don't have to pretend. No need to defend yourself. No need to prove anything. You can simply be yourself. And that's exactly why those relationships grow deeper and faster. It's the same at work. Teams built on trust move twice as fast because they don't waste energy second-guessing or decoding hidden motives. Covey said, "Trust is not a soft virtue. It's a hard-edged economic driver." Trust isn't a feeling. It's a competitive advantage. Trust compounds like interest. You can't build trust with a single good act. It's a long-term investment. Each small promise kept, each honest choice, every moment of integrity during hard times is a deposit into your trust account. And over time, it compounds. An honest word today becomes credibility tomorrow. A right decision today becomes an opportunity later. A kind act today becomes a network of trust in the future. When people trust you, they recommend you, protect you, and bet on you. That's what Covey calls the return on trust, or ROT, a form of profit that can't be measured in dollars, but generates every other kind of wealth. The real speed of the wealthy? The rich don't move faster. They're simply less slowed down, less doubt, less fear, less friction. Because when you operate with trust, you eliminate resistance. And when friction disappears, speed naturally appears. Trust is a force multiplier. It amplifies every skill, every strategy, every opportunity you have. An ordinary person with high trust will always move faster than a genius trapped in skepticism. The final lesson? Be the person people can trust. In an age of scams, deepfakes, and fading integrity, the truly wealthy are those who can still be trusted. Let every action you take be a trust investment. Keep even the smallest promises kept. Be honest when no one is watching. Value principle over short-term profit. Because in the end, your speed in life and in business will rise or fall with the speed at which people trust you. And that's why Covey calls trust the one thing that changes everything. Trust isn't just a moral value. It's the foundation of lasting wealth. If you want to understand more deeply how trust can become an invisible asset, one that helps you build wealth faster, stronger, and with true freedom, check out the book, The Speed of Trust, through the link right below this video. Sometimes just one chapter can completely change the way you see what it means to be wealthy.